Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have that update from Rory. Now, listeners, you're going to find the download link for this week's Trade of the Week in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage and look for the red button over Michael Every's picture saying looking for the downloads.
Patrick, for this week's Trade of the Week, Michael Every argued that policy may be shifting away from broad support for financial assets and toward the physical economy. Patrick, for investors who subscribe to that view, what's the most practical way to express that industrial rebuild theme in the market?
Michael Every's argument was that we may be entering a very different policy regime where the focus shifts from simply supporting financial markets to rebuilding the physical capacity required for economic statecraft. That means infrastructure, supply chains, ports, transportation, industrial production, energy systems, and strategic manufacturing all to become more important. So rather than trying to trade the next headline around Iran, oil, and Fed policy, this week's Trade of the Week is about positioning for a broader industrial rebuild theme through the PAVE ETF, which gives diversified exposure to U.S. infrastructure and physical economy investments. From a trade construction standpoint, I want to keep this one simple by taking the outright exposure to the PAVE ETF, which is symbol PAVE. The ETF is trading around $57.24 at the time of recording. The objective is to own the shares as a long-term position tied to the industrial rebuild theme. The tactical concern is that the broader market has already rallied aggressively, with the S&P 500 moving almost 20% from trough to peak in roughly 2 months. That kind of move can leave the market short-term overbought and vulnerable for consolidation, backfilling, or a summer correction. So rather than ignoring that risk, I want to build some short-term protection while still establishing a longer-term position. To manage the short-term risk, I'm pairing that long PAVE share position with a near-term protective put. Specifically, I'm looking at the July 17th, 2026 $55 put, which has roughly 43 days to expiration, which is trading around $1.25. That strike sits almost directly on the 50-day moving average, currently at 55.06, making it a logical short-term technical support level to define the hedge around. If the market keeps rallying, we stay invested in the shares and the put simply acts as an insurance. But if we do get a short-term correction, that put provides downside protection and gives us flexibility to either repair the position, roll the hedge, or improve the average cost base into weakness. From a payoff perspective, the effective cost of the stock plus put position is about $58.49, including the options premium. The protective put defines the short-term floor at $55, limiting the risk through the expiration to roughly $3.49 per share, or about 6% from the combined entry cost. The result is a way to establish a long-term exposure to the industrial rebuild theme while retaining tactical flexibility if the broader market finally decides to exhale after a nearly vertical rally.
Patrick, every Monday at Big Picture Trading, your webinar explains how retail investors can put on our most recent Trade of the Week. For those listeners that want to explore how to put on these trades in greater detail, don't miss out on a 14-day free trial at bigpicturetrading.com. Now let's dive into the post-game chart deck.
All right, Eric, let's dive into these equity markets.
Well, Patrick, the rally continues to astound me. 8 days up, 1 day down. That's a great pattern when you can get it. But this can't last forever. And experienced investors know the longer that the unsustainable sustains, the less likely it is to continue sustaining. I'm still convinced that President Trump is wrong to assume that time is on our side in the Iran crisis. I think the opposite is true, and I think a big oil price spike could still pose a serious economic risk. But one thing's clear, equity markets just plain aren't concerned about that risk, at least not for now.
Eric, you're absolutely right about it being an astounding move. Going back almost 20 years, there's only 4 times we've seen a rally of this magnitude, and certainly, the market is stretched on almost every metric. When we put on something like a relative strength index, you can observe the incredibly overbought conditions of these markets on the short term. So at this stage, that usually implies that the stock market will have a ceiling, which is essentially it's going to be very difficult for it to make further progress. It's just overextended. But the bigger question is there going to be a bigger, deeper market correction here? And what would be the trigger? Well, first of all, we're still quite a ways away from systematic trading strategies kicking in or selling. And so it's not like we're at the edge of a cliff here, but on the short term, the markets could start to wobble here, and we start seeing failed rallies and some more active distribution. Certainly, a catalyst such as oil breaking north of 100, causing disruptions in the bond markets, could certainly act as a catalyst to create some nervousness that could spur profit taking. We'll certainly see how it plays out. At this stage, the way I would very simply summarize it is a very poor asymmetry at this moment for pressing the market higher, and certainly hedging up and or reducing exposure is a very logical thing to happen in these kind of market conditions. All right, Eric, let's talk about this dollar.
Patrick, we're holding steady around 99.5 on the Dixie. It hasn't turned down, but it's not breaking out to the upside either. Then again, the war action was mostly muted, and it appears to me that President Trump and his administration are going to limit their actions, at least for now, to what they can describe as self-defense strikes, apparently trying to hedge congressional oversight challenges. Of course, they can't pass a law like that. President Trump would just veto it, but there's some political headwind that he's facing there. So I think there's still room for an upside breakout here if we return to a full-scale military conflict in the Iran theater. I have a feeling we're going to eventually, but it seems like President Trump is trying to hold off on that for as long as he can. So I'm not sure when it happens. If we do get that escalation, I think it probably takes the dollar back up again.
Well, Eric, the dollar is attempting to break out of a 1-month trade range through the month of May here in early June on the upside. And that's really on the back of the euro at this 116 level. And the way I look at it is that we now have the ECB coming up next week. And if we see that the situation in Europe is in any way deteriorating, we may see the euro being the outlet for a weakening or deteriorating European condition, which would by default allow the U.S. dollar to rally. And so I'm watching Europe very closely here to see whether that's where potential strength emerges. All right, Eric, let's talk about this oil chart.
Well, what's clear to me is no deal is in sight with Iran. Total disagreement on the nuclear file, which has been the key issue through this. When President Trump tweeted this week, Iran has agreed to no nuclear weapon. That's not news. It's a red herring. Iran agreed to no nuclear weapon years ago. That hasn't changed. It's been a consistent part of Iran's position ever since this conflict began. What they've said consistently is they do not have, nor do they intend to develop a nuclear weapon. However, they are not willing to give up their enriched uranium, which is the key ingredient needed if they should ever change their mind. They're trying to maintain what's known as a nuclear threshold state condition, which means they've got the material they need that they could develop a nuclear weapon if they ever decided to, but they have not made that decision yet. So Iran's position has not changed. There is no news. The president is just retweeting old replayed tapes, I think, in an intentional effort to just jawbone the oil market lower. Maybe he's confused on that point, but he's done that so many times now. I don't think he's confused. I think he understands what's going on. I think he's just trying to jawbone the oil market lower. One way or another, the market seems to finally be very slowly waking up to what should be obvious, which is there is no deal. There is no hours away from a deal. That's all a bunch of baloney. I thought the Labor Day tweet that I discussed with Rory Johnston was the biggest tell of the week, where President Trump said that the U.S. embargo on Iran could be lifted as soon as Labor Day. Labor Day is not soon. We're talking about American Labor Day, the one that happens in September. So, if we're going to be Strait of Hormuz substantially closed or only at the very, very muted, limited flows, less than 10% of normal that we have now, if that's going to continue for the next 3 months until American Labor Day, it's going to have an absolutely crippling effect, I'm convinced, on energy, and it's going to eventually force a move much higher in oil prices. How much higher is anyone's guess. The thing to watch here, the big curveball that could really accelerate that quickly, would be a closure of the Strait of Bab el-Mandeb. That's the bottom of the Red Sea, the other side of Saudi Arabia. Right now, the oil that can't get out through the Strait of Hormuz, a lot of it is getting pipelined over to the Red Sea, and it's coming out through the Strait of Bab el-Mandeb. So if that gets closed too, and it is well within the possibility of the Houthis and Iran's proxies, that could definitely escalate things and escalate them very quickly. I think whether or not the Israel-Lebanon conflict re-escalates will probably play a big role in that. So I don't know what is happening or what to predict or when it might happen, but a closure of that strait would really add fuel to this fire and add it quickly.
Eric, I'm keeping it simple. Clearly, there's going to be a floor under oil. You can't deplete hundreds of millions of barrels of oil inventory and then make a bet that oil's returning back to the pre-war levels, even if there was a peace deal. A new, higher, elevated level of oil will keep a structural floor underneath crude, which to me makes it an asymmetric trade, because even if the oil doesn't rally, you have a definable and manageable downside risk. But if the story about depleting inventories catches up with the markets, and we do need to see some form of demand destruction from higher prices, to me, it's an incredible asymmetric trade. I'm continuing to look to see whether or not and how I can play the oil upside here in this kind of a macro backdrop. So moving on here on page 6, Eric, I have that gold chart. How do you size up the gold markets here?
Patrick, so far the 200-day moving average has held. When we saw that test right around 4,400, that's where the 200-day was now. It's up to about 4,415 now, 4,415. So far, that's holding, at least as of recording time. I won't be surprised, though, if the Iran situation continues to persist, if that does not hold. So let's see what happens, but unless there's a rapid resolution to the Iran situation, I won't be surprised if we take out 44.15 to the downside. If that happens, we could see an acceleration of the move lower. So anything's possible here.
Well, Eric, I still look back and say, well, we had a parabolic blow-off at the start of the year on gold, and we've basically been in a 4-month consolidation. The price action remains distributive in nature. Every rally fails. There was active selling of gold here, remains below its moving averages. The trend is clearly lower, and it's got macro headwinds, such as the fact that the dollar is attempting to strengthen, rates are rising. And so all of these things are generally going to be like a wet blanket thrown on top of gold. While I'm not necessarily bearish outright, I don't see any reason at this moment for the gold bull market to begin. I think at this stage we should really anticipate the remainder of the second quarter of the year to be a lot more of the same. And we can see whether or not the third quarter brings around a much more bullish scenario. All right, Eric, let's touch on uranium here.
Patrick, I couldn't possibly be more bullish long term, but it's a little bit concerning to see the broader market really at these extraordinary levels, and uranium just hasn't participated. Now, we did see a very encouraging pop higher on Tuesday. That came on the back of the nuclear fuels conference. but it pretty much completely retraced lower on Wednesday at the same time that the broader market moved lower. Now, the broader market only moved a little bit lower. If we saw a full retracement of this big rally in the broader market, I think that could take uranium shares substantially lower. So a correction here is entirely possible. It doesn't change my long-term view at all. I'm a long-term investor, and I am committed very much long-term to uranium. But I think we could see a soft patch here. Seasonally, this is a weak period until late August or so. Maybe we'll hold steady, but I don't think we should expect a big rally or all-time highs or any of that until we get into the seasonal buying period, which normally starts right around the WNA conference, which I think is the 7th through 11th of September this year.
Well, uranium as a commodity has been incredibly quiet and stable, and even the uranium stocks have seen a lot of failed rallies and a lot of trade range consolidations. I'll agree with you that the bull story is quite intact, in that inevitably there's lots more room for the uranium stocks to have more bullish upside. But as of this moment, this remains an inactive market, and we're going to see when the uranium market finally genuinely wakes up and gets things really going. So, Eric, I just wanted to very quickly just touch on the copper markets, which continue to trade at 52-week highs. It's actually probably the most bullish chart in the commodity space, in that it's trading along its highs. Old dips continue to be bought, and it has very clear momentum. At this stage, it will be interesting to see whether or not copper can break to that fresh new high and make a gun for the 7 level on the upside.
Patrick, before we wrap up this week's podcast, let's hit that 10-year Treasury note chart.
We obviously had a several week pullback here off of that 470 level on the upside, but that came on the back of some oil weakness. Now that we're seeing the potential for oil to once again be turning higher, the big question is, will we see the correlation remain where as oil goes higher, inflation expectations rise and yields rise along with it? That's certainly been the story for the last 2-3 months. And it's going to be really interesting to see whether that correlation continues to demonstrate itself here as we go. The bigger question to ask is, can we see a 5% handle on the 10-year yield? It's certainly at this point the path of least resistance, the way these charts look at this stage. I'm not seeing the bond buying opportunity just yet.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find the transcript for today's interview, as well as the Trade of the Week chart book we just discussed here in the postgame, including a number of links to articles that we found interesting. You're going to find this link and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. And for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main account on X at MacroVoices for all the most recent updates and releases. You can also follow Eric on X at Eric S. Townsend. That's Eric spelt with a K. And you can also follow me at Patrick Ceresna. On behalf of Eric Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.